Should you save money in a high yield savings account or in a whole life insurance policy, which we call the sacred account? I'm going to give you that answer today on Fetta Facts. Hey, welcome back to Fetta Facts. This is Jerry Fetta, CEO and founder of Wealth Dynamics. So I had the question come up, should I save money in a high yield savings account or in a whole life insurance policy, right? And I wanted to give you the answer to this question. Again, Fetta Facts, it's all about the facts, right? No opinions, all facts. And this is all about stuff that I'm doing, I've experienced, so that you can actually see, okay, good. This is someone that knows this, they're using it, and here's what they're telling me, right? So the question, should I save money in a high yield savings account versus in a whole life insurance policy? Okay, so here's the first thing. We've all seen more advertisements for high yield savings accounts, haven't we? Hey, I see them on billboards. I see literally, I'm driving down the highway and it's like, earn 5% on your money, high yield savings account, high yield CD, certificates of deposit, right? And so the idea is if I'm going to put money in there, I can be earning 4 or maybe even 5% on that money, right? Now, here's the problem, right? If you've ever saved money in a bank, you're going to know two things have happened. Historically, their rates vary. So high yield today may not be high yield tomorrow, right? It's all relative. So that's part of it is, okay, good, get it while the getting is good, but how long is the getting going to be good for? When do rates come back down? Because right now rates are high, they're keeping them a little higher. At some point, what if they come back down again, right? So my experience with this is, guys, I own 6 life insurance policies called sacred accounts. I use them for my own banking system. I like to think of myself as a benevolent banker. And I want to share with you today how I'm using this. Well, hi there. I bet you're wondering why I'm holding a golden octopus. Well, the reason is you should get a copy of my book, The Blueprint to Financial Freedom. And that may or may not explain to you why there's a golden octopus, but it will help you become financially independent, which, if we're honest with each other, it's a little more important. First things first, let's whiteboard out a couple of concepts. And I want to talk to you about this thing called the banking quadrant. Okay, the banking quadrant. Now, the banking quadrant is important because this is really what happens when you put money in a bank at all, period. Okay, so banking quadrant, we're all familiar with this. If we've seen this before, if not, when you have a bank, there's 4 parties that always exist. Okay, 4 parties, 4 players in the game, if you will. Okay, player number 1 is the depositor. You're used to this. Usually the depositor, that's you, that's me, we're saving money in the bank, right? So a depositor, they deposit earned income, right? Then we have the banker, okay? So most people aren't aware of this, but the banker, their job is actually to borrow against deposits to invest them, okay? Now, we're used to typically just the depositor, and we're also used to the borrower because those are the two things we do. We borrow money from the bank, we deposit money into the bank, okay? What we're not usually aware of, or at least interacting with, is the fact that that money we've borrowed was someone else's deposit. That money we've deposited will be someone else's loan, okay? So the question is, again, is it better to put money in a high yield savings account versus putting money into a sacred account and using the banking quadrant, using the infinite banking concept? Okay, so on a depositor, let's check this out. If you put money in a high yield savings account, you might earn 3 to 5%, and you might also have 100% liquidity on your money, right? Your money is 100% liquid. It's going to be there. You can pull out all of it, right? And you have 3 to 5% growth. And I'll admit, compared to prior in recent years, that's not bad because you were looking at savings accounts that didn't even do 1% 3 or 4 years ago, right? So if you're earning 3 to 5, like, wow, right? Wow, this is climbing up there. Now, if you go all the way back into like the 1980s, there were some savings accounts that were paying 7, 8, 10, 12% because interest rates were that high, right? So you're getting paid 3 to 5%. My first question is, where's that 3 to 5% coming from? Have you ever wondered that? Like, a bank is basically a storage facility for money, right? It's like going to a storage facility, renting out a unit, putting your money in there. I've never used a storage facility that pays me to store my stuff. To me, that's already off. I'm like, why are you paying me? I've got an old couch. Why are you paying me to I'm going to put my old couch in your storage? I'm the one that's going to make the money. That doesn't make any sense. I'm trying to get rid of the inconvenience of an old couch by putting it in some storage. I'm willing to pay for the service of using the storage. So if someone's like, no, 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 it's free. Not only is it free, I'm going to pay you. All of a sudden, I'm suspicious, right? Why are you paying me? It doesn't make any sense. How are you, if you're paying me, how are you paying for the storage? How does the building exist? It costs you money for me to put my stuff here. How are you turning a profit and staying in business, right? I'm starting to look at, like, I've been watching some Breaking Bad recently. Is this some kind of a cover operation? Right now, I'm not saying banks are a cover operation, but I am saying it begs some questions, right? The fact is, you are being paid 3 to 5% because the bank is borrowing against your deposit and they are making more than 3 to 5%. How much more? There's a study done that shows that banks make on average about 1,400% more than their depositors make. Okay, that's by BauerFinancial.com. You can check that out. It's about 1,400% more than they pay their depositors. How are they doing that? Well, because they're loaning the money out to borrowers or they're investing it in markets, and they're making 1,400% more than the 3 to 5% that they're paying you. So let's do the math on this really quick. Okay, so you're putting your money in the bank. Hey, what's up? Jerry here. I just wanted to give you another reminder. Grab my book, Blueprint to Financial Freedom. It's going to be one of the best books you have ever read on finance. I can promise you that. You're going to love it. It's also a free offer. So if you go to jerryfetta.com/B2F promo, you can get that now. Let's say they're paying you 4%, right? 4% is what they're paying you, and they're making 1,400% more, which is 14 times the money that you're making. So 4% times 14 times means that they are making on average 56% on your money and paying you 3 to 5 of that, right? So this is because they get to be the bank, isn't it? It's not because they have some special magic secret account, because the reality is they're not putting their money in their own bank account. They're not leaving it in savings accounts. They're going out and they're actively investing that money or loaning it out to others. Okay, so the question for me is not, should I put it here or should I put it there? It's not even an apples to apples comparison. The question is, should I deposit my money and let someone else borrow against it that's going to pay me some interest? Or should I deposit my money so that I can borrow against it, cut out the middleman, and earn the interest they're earning? Right now, I'm going to be real with you. You're not a bank. You're not going to make 56% on your money, right? But what if you could make 8 or 10 or 12% as the borrower, taking loans against your money, right? And you could still make this 3 to 5%. Think about that. You're still making the 3 to 5 that you're gonna make in a high yield savings account. That part's apples to apples from a number standpoint. And you have the ability to be the banker and borrow against that money and earn an additional 8 to 12% on top of that while the money grows. Okay, I want you to consider, which game do you want to play? Because one of these is a very passive game. I'm literally passive. I'm depositing my money in, and that's it. I don't want to be involved. I don't want to know about it. I don't care that they're getting rich off of me. I don't care that they could lose my money. I don't care that FDIC insurance is underfunded. I don't care that when it does pay out, it's funded by taxpayers. So I'm going to bail them out anyways on my own money that they lost. I don't care about any of that. I just want my 3 to 5%. Give me my 3 to 5% so I can sit it in the bank and I can continue on with my life and not have to think about or be responsible for my finances. Okay, that's method number one. And if that's you, that's fine. My program's not for you. My services aren't for you. Stay with Wall Street, stay with the banking system. You'll be very happy there. You won't have to lift a finger, right? Now, my system is what the wealthy have done. That's the sacred account, right? The idea is not reduce responsibility. The idea is not be completely passive with my investing, because the reality of life is the things that matter in life we cannot be passive with. You cannot be passive with raising your kids. You can't outsource that. You can't be passive with going to the gym. Someone else can't do your workouts for you. Okay, you can't be passive about taking care of your body and getting enough rest. You can't have somebody go to sleep for you. You also can't be passive about your money if you expect to build wealth. Somebody else is not going to earn the money for you. Somebody else is not going to save the money for you. And contrary to popular belief, somebody else is not going to invest the money for you. You might be like, oh, well, Wall Street and the banks, they do that all the time. No. They're investing it for them. Legally, they just have to include you. Trust me, if they didn't have to include you, they wouldn't. If they could just take your money and make fist over fist profit, 56%, not pay you the 3 to 5%, I'm sure they would do that. Legally, they can't. So it's between involve you in the smallest way possible or go to prison. They're going to involve you in the smallest way possible. Okay, so this is not a question to me of, is the high yield better? Is the bank account better? It's a question of, do I want to be the banker or do I want to be used by the banker? And I think you know the answer, okay? So guys, if this video is helpful for you today, like the video, grab my book, Blueprint to Financial Freedom. You can tune in for my channel, subscribe. I'll see you guys next time on Fetta Facts. Hey, this is Jerry Fetta here. I want to thank you for watching my video, watching my content. I hope you enjoyed it. If you would like to learn more about the Blueprint to Financial Freedom and how you can achieve passive income that exceeds your savings, your expenses, your taxes, your generosity, and build wealth like the top 1%, I want to encourage you, grab a copy of my book, The Blueprint to Financial Freedom. You can go to jerryfetta.com/B2F promo, or you can click the link in the description of the video here. The copy is free. You cover your shipping. We'll send the book out to you, and we'll send you an email with a bunch of great bonus material also for free. Get the book, subscribe to the channel. I'll see you on my next content.